We are live, Amar. So welcome aboard, everybody. Hey, Deb. We got Amar is with us. Let me just make sure we can be seen here. Amar.
You want me to stop sharing? Then why don't you do the one that has both of us side by side?
Okay, let me stop sharing this real quick. There we go. All right.
There you go.
We're both side by side. All right, looks like we're good. Let me just hold on. Let me get on here real quick. All right. So welcome aboard, my friends. I'm very much looking forward to this one because I actually think that just talking to a lady earlier today, Amar, she's a realtor in Colorado, and she's saying literally people are lining up for showings in houses, literally. So a showing goes up, people are lining up for a 15-minute opportunity to bid on a house.
See the house, yeah. I think the same things happen here in San Diego, and at least in my neighborhood down the street, there's a house that was built in 1926. It looks like nobody's taken care of it for the last 15 years. Like the foundation's messed up, the roof is messed up, like everything. It's like one of those houses that needs to be demolished and just rebuilt. But we were driving by and there was a line of people there as well. And I bet you it goes over what it's asking for. It's crazy.
Well, she was saying that people are waiving appraisals even though they're getting a bank loan. And so what they'll do, the bank's like, I'm not going to give you money if it's below appraisal. So they will come up with $100,000-$200,000 cash. Crazy. So the point being is now we have interest rates creeping up. We have a market that's certainly not cheap. I don't think anyone would argue that this is a cheap market. Doesn't mean it's going to drop tomorrow, but my goodness, folks, if you're not doing some kind of mitigation strategy on protecting the downside, I think you're making a mistake. And as such, this is what we want to do here today. And this isn't we're not doing some kind of mitigation. Hold on a sec. Let me just get that. There we go. All right. So this is not to say you need to go out. Can you still hear me, Amar?
Yeah.
This is not to say you need to go out and sell all your stocks. Not saying that at all. I'm just saying at the end of the day, if we're about ready to retire, my goodness, you better have a plan of action to protect the downside. So, Amar, you want me to?
And with that, it's, at all times, right? Nobody has a crystal ball, right? Like we don't know what's going to happen in the market next week, the week after, 3 weeks, a year out, right? But part of your portfolio is kind of like insurance to protect on the downside, right? And so that safety of margin or your downside risk appetite needs to be something that you have that dialed in throughout investing, right? And throughout retirement. So do you want to put the slides up there? And then what I can do is put the disclosures up.
And we're going to have ample time for questions too, guys. So if you all, when Amar is going to give us the slide presentation, which shouldn't take a huge amount of time, and then, but there's a lot of critical stuff in there. So if you have questions at the ready, we're welcome to hear them because there's a lot to think about for sure.
Yeah, and so let's see if I can hide that. All right, cool. So these are disclosures again. We're not taking into account your personal situation. We don't know about your specific positions. And so this is purely for educational purposes. We're not giving investment advice. There's no guarantees of past performance for future. Is there any other disclosures, Josh, you can think of that we should say?
Every investment strategy has cost. I mean, just
every investment strategy has a cost. Yeah. So, what is downside protection? So, downside protection is you want to limit your capture ratio on the downswing in the markets, right? So, what we mean by this is that if you think of the markets, they don't go straight up, right? They go up and down, up and down. There's ebbs and flows. And what we want to do is reduce the capture ratio of the downside. So that way we maximize our overall return on the positive side, as well as over the long term, right? And so today what we're going to talk about is 3 strategies that we actually use in our firm today. And we use them for a variety of clients. So the first thing that we're going to talk about is tactically allocating. And we're going to compare what we do compared to the industry. So you kind of get a benchmark there. Then we're going to talk about structured notes and then options, buying and selling puts and the advantages of that. Now, not all of these strategies will apply to you. And roughly speaking, 85% of our clients, we use a tactical allocation. Probably about another 10% we're using structured notes, and probably about 5% we're using options, right? And there's specific types of people that will fit into these buckets, specific circumstances that will fit into these buckets. For example, options we typically use with executives that have concentrated positions in company stocks. So that way, we're not creating a huge tax event by selling company stocks to diversify, but we're also limiting the downside exposure, right? And I guess there's some tax consequences of that, but not as great as if you were to sell all of the company stock. So one of the things that's important is sequence of returns. You want to talk about that real quick, Josh?
Yeah, all the time. So, and again, it's sequence of return risk is simple. If you retired in 1999, the latter part of 1999, you went into a buzzsaw. If you had the S&P 500, you take your portfolio and you were down 9% in 2000. So $100,000 minus 9% equals 91,000. The next year you were down 12%. In 2001, down 12%. You're down to 80,000. The next year you were down 22%. All right. So now you're down to 62,000. And actually the first 2 months of 2003, you were down another 8%. So by the time March of 2003 rolled in, you were down to $57,000. So remember, if you had a 5% distribution rate, that's, the 4%, I use a 5% rule, and now you're taking 5% adjusted for inflation, we're going to say you're taking $5,300 divided by $57,000. Now you're taking a 9.3% distribution rate. That's tough, man. That's tough.
High. That's high.
And you're only 3 years into retirement.
Yeah.
And I'm just telling you. And then you're like, okay. And then it goes back up, and then you get the second buzzsaw, the aftershock, and that was in 2007 to 2000. Yeah. And you're screwed.
Yeah. So I guess the first thing we should talk about is when you're in retirement and you're withdrawing funds, you always have to have cash on hand, right? And so if you had cash on hand on Josh's example, that would have helped reduce some of the withdrawal rate risk, the sequence risk. But even with these strategies that we're talking about, you're going to want to have cash on hand. Now, a traditional investment portfolio is typically long only. What I mean by that is that you buy a basket of assets using the modern portfolio theory, and you're going to be based off of your risk in an asset allocation model, and then that model is going to go up and down with the market, but that risk is based off of the amount of volatility you can handle. Now, what we do is we have that, but in addition to that, and we use BlackRock to help create our models, but in addition to that, we do our own risk mitigation. And typically about 30% or so of that asset allocation is going to be tactically allocated. And how we define how we're going to allocate those funds is from this map right here. And this in here, we have different quadrants. So think of this as quadrant 1, quadrant 2, 3, and 4, right? And what we're looking at is the rate of change in terms of GDP and inflation, right? And we don't know what those are right now for quarter 1 because we don't know until after the quarter. However, there are research firms out there, and we buy research from a third-party company. We're not doing this research. And they predict where is GDP, where is inflation going to be. And so we buy this research, and then we determine what quadrant we're in. If we have over an 80% probability of being in a specific quadrant, that's when we know we have to do some risk mitigation. And that risk mitigation is really about making sure that we own the right sectors for those quadrants, right? So right now, I deleted these, but in Q1, we have the rate of change of GDP is positive and headline inflation is positive. So that shows that we're in this quadrant right here, right? And this is a quadrant 2. So in quadrant 2, things that we own right now discretionary, industrials, and energy on the equity side. And the fixed income side, we own high yield and tips. And then we have some exposure to commodities. Now, this doesn't mean we don't also own gold. We don't also own REITs. We don't also own technology, for example. But these are things that we're overweighting in this environment. And when this environment changes, right, if this becomes, let's say, quad 4 right here, which is decreasing GDP, meaning the rate of change is decreasing and inflation is decreasing as well. Yeah, this is bad, right? You don't want to be here, right? And so based off of this map, we're going to overweight certain investments, and based off these investments historically, the risk versus reward has been highly correlated to the quadrant that we're in, right? So we can see that when GDP and inflation is decelerating, government bonds, you want safety, right? I mean, these are things that you're going to want to own in this type of environment. But you're not going to want to own government bonds when we're having increasing GDP and increasing inflation, right? So this is what we do, and this is kind of the model. And this is why clients, would pay us a fee, is really on the downside protection, right? And on the upswing, you're not going to, there's a cost to these strategies, right? And that cost is really protecting on the downside. Right?
Easy to make money on the up. Everybody's making money on the upside. Everybody's a genius. It's a whole different ball game when it goes south, though. That's a fact. It's actually kind of funny. Along those lines, with the tactical allocation, I just want to point out, my friends, is that Amar says something. He kind of brushed by this. He is paying other people to do the research. The reason that's incredibly important, and this is what drives me crazy about fiduciaries who also do their own stock hunting and stuff. I'm like, whoa. How much time do you have in a day to do the trading and the client discussions at the same time? And Amar's like, I got to talk to clients. That's what I do. And I don't have the time to do the research, the analyzation, all this stuff. I have to talk to people because that's what they're paying me for. And they're paying me to kind of manage the other people who are doing the research. And I've always wondered, I said, I don't get why people don't get this. If I'm picking the stocks and I'm talking to clients and I'm making a sale and doing all this, something has got to give.
Yeah. And like even right now, like we're talking right now, the markets are on, right? Like I can't be doing two things at the same time, and it's very difficult. So, well, for other clients, and again, this is roughly 10% of our clients that are more conservative, they're more risk adverse, that would like some protection on the downside to just say, hey, this is I know I'm not going to lose more than X. Throwing in some structured products in the asset mix may make sense, right? We're not giving investment advice, but this is a way where we can have a set term, and in that term, we know what the outcomes are going to be. And you don't have to worry in between that term, right? And at the end of that term, you'll know either you'll have your principal back, you'll have some rate of return pegged against some equity indexes, right? And then there's a cap, right? And the cap gives up on the upside to give them the protection of the downside. And so for conservative individuals, this tends to be a good product that kind of fits that need in there.
And we talked about structure notes a couple of weeks ago, and you're giving away some upside for guaranteeing the down. And I'm just telling you, I did a video on this yesterday, Amar. You just got to change your mindset once you hit retirement. And this is the nice thing about us being in this business, Amar, is we are not at retirement, but we work with people who are, and we have the ability to kind of say, this is the mindset that comes in retirement. It's tough when you're in accumulation mode to kind of switch that, turn that switch to say, oh boy, now I still want to get growth. And this fund did better than that fund as a growth. And I'm like, but growth isn't what we're trying to accomplish anymore in retirement. That doesn't mean you go all in the bank. It just means at the end of the day, we are potentially going to have to sacrifice some upside to make sure we don't get the sequence of return risk that I talked about earlier, for sure.
Yeah. And so Yeah, exactly. Like, I don't know. I've probably worked with maybe several thousand people at all different stages of retirement, right? Like my oldest client is 104. I work with his family, and then I have clients that are just starting to retire, right? That threw a retirement holiday party last week, you know? So we, as an advisor, we can see different stages of retirement, different phases, and we can help factor the investments to correlate to that from a risk perspective, right? And so this is the second way that we can use is structured notes. And remember, there's growth notes and there's income notes. So you have to pair the right note for the right piece of the pie in terms of allocation. And we did a video on this, so I would tell people to just check that out versus digging too much deeper into this.
I'm not against them. It's a lot of, I just want to be clear. It's like, I'm not against anything that's out there as long as there's a methodology behind the reasoning for us to get it. And I just think a lot of people, myself included, say, oh, I don't know. But what are we trying to accomplish, guys? What are we trying to accomplish? What is the point of our, Nancy says 104. What does 104 mean? I'm not sure what that means. But anyway, so remember, there's always got to be a reasoning what we're trying to get done here. And if you don't have a reasoning, what's the point? So just keep that in mind. And this is the big one right here. And this is where Amar, just real quick, remember, and Amar, we don't say this enough. We need to. Amar is a CFP, but he's also a CFA, a chartered financial analyst. And that's a pretty big deal, a CFA. There's a lot of math crunch in there. Amar's an engineer by trade. And however he passed the board, I don't know, but he did. He got his CFA.
Yeah.
Stuff that a CFA can bring to the table that a CFP typically can't. A lot of people mix the two. They're not interchangeable at all. One's specific for this. So go ahead, Amar.
Yeah, and this is really for those individuals that have concentrated positions that don't want to totally get out of their position, or they want to protect their position. So we use options, and we use options in two ways. And this probably only applies to about 5% of our client base, but this could apply to you in the sense that you want to lock in a value of a stock. We have an example here. So let's say you buy 100 shares of XYZ stock, right? We can buy a put for those 100 shares. It's one contract, and it'll cost us $3.25, right? So our total cost per share is now $103, right? So typically individuals will already own this share, their stocks, and then we're trying to build in the protection for them. And so in this case, we're trying to maximize risk is limited to the $3.25 for the cost of the put.
Yeah.
Because if the stock goes down to zero, right, you've protected yourself. And then on the upside, now you bought that stock at 100, but you have to clear the 325 in order to get profit, right? So the first 3% of the stock, 3.25%, you're not going to make return. It's going to kind of net out that insurance premium, right? If you want to call it insurance, the option, until that. So you're making profit on $3.25 and on, right? With the same stock, if you're bullish with this, if you thought the stock was going to do well and you're not too worried, but you want to drive income, you could sell some puts, right? And you could collect this $3.25. Oops, $3.25 on the flip side, and you can collect those premiums, right? Which you would get over time. Now, if there was volatility and the stock went down, yeah, you would have to sell your shares, but you can make sure that they're so far down out of the money that you feel there's a comfort level, right? Where the probability of them actually being called, less than 15%, whatever you want to use. You find where that strike price is, and that's what you should really be buying. And then that could help drive some income.
It's funny because when I was at USAA, we had a lot of ExxonMobil employees down there in Houston. And I remember this one lady. I remember it was like the nicest lady I ever met. Her Monte Carlo showed her her asset allocation showed she had a very well diversified portfolio. She didn't. She had half in cash and half in Exxon, and she loved Exxon. Exxon was never going down, and I'm not here. I own Exxon, and I said, this is a long time ago, 10 years or so. But I said, what happens if? What happens? Well, we're not like Enron, because Enron is in Houston. And I'm not saying it's Enron. I'm just saying what happened. I mean, I remember that BP thing in Louisiana, the British Petroleum.
The oil spill.
Yeah, exactly.
Yeah. The pipe they had it on the video. It's just constantly spewing like 24 hours a day. Like,
remember that? It was on just this running tally of this. It was weird. But anyway, I said, well, I mean, what happens if the CEO becomes crack addict? I mean, there's all these different things. What happens if? And anyway, and she's I'm not selling it. So that's fine. It's her money, do whatever she wants. But as an advisor, I had to say, hey, there are other strategies that you can keep Exxon. But at least protect your downside. And you are going to spend money on a premium, but if the market goes up, you could get that premium back. If the market goes down, you'll be glad you paid for the insurance. And that happens a lot with people who are heavy into one position that they got through stock options.
Yeah, and again, it's like insurance, right? Like if you have a house, right, you pay homeowners insurance, right? That's to protect your house. This is the same thing, if you have a concentrated position. And I think the big thing here to take away is that most advisors that are in, like, let's call them big box retail advisors in the firms, the only option is to systematically sell out of your concentrated position to re-diversify in a diversified bunch of securities. And we're here saying that that's not the case. You can protect a concentrated position through the use of options. Right.
And against the S&P 500 too, Amar. I mean, so it doesn't have to be just one Exxon stock. It could be against the market as a whole too.
Yeah. I remember this is pre-USAA days. I was working with an individual that 100% of their money was just in the S&P 500. He's like, I don't understand investments. I just picked the S&P 500 and didn't want to diversify out of that, right? And Charlie has a question about tax rates, and that is a good question, and it actually depends. So if you are writing options on an index, it's actually very tax advantageous. You get 40% as ordinary income, 60% as long-term capital gains.
Really?
So, on an index. If you're doing a specific stock, then that's going to be all short-term, right? And also, depending on the duration of this put, right? If you do a short-term or if you do a long-term put, that would affect that. But the advantage, though, is if somebody's in a high tax bracket and these are after-tax stock options, and there's a index that we can correlate the position to, right? Because if you look at the S&P 500, it's mainly Apple, right, and Microsoft, right? Like the tech companies are a larger percentage than like all the other companies in there, and so you can take advantage of getting favorable tax treatment on a short-term basis, right? Imagine 60% of your gain is long-term capital gain, and it's only a month that you have that option, right? It could work into your favor.
Oh, that's interesting. Yeah.
Another disclosure is that we're not CPAs, and you should talk to a tax professional to verify. This is one book I read a long time ago, and I thought I'd use this as an illustration here. Wall Street Secrets for Tax Efficient Investing. This gentleman, Robert Gordon, he actually spoke at the CFA conference a while back. I wasn't able to go, but I reached out to him and picked his brain for a little bit.
Oh, you did? What's his name? Robert Morgan?
Gordon.
Okay. Gotcha.
Right there. He has now passed, pre-COVID passed away. But a great guy, helped me out a lot. But I learned a lot from this book, and I would recommend it.
Yeah, right on. All right, Michael says, is it true that time in the market is better than timing in the market? Time in the market, all right?
Yeah, that's absolutely true. I mean, if you look at history, time in the market is 1,000% better than time in the market. Now, people get this part wrong, right? Yeah. They say, I knew this thing was going to go down, so that's why I sold out. And look, I'm a genius that it went down. But the part that they fail to realize is that they never got back in, right? They were so smart at getting out. And it's kind of funny to see how smart they were to get out, but they never got in. And history has proven that you may get the first timing right? It's a flip of a coin, right? You have 50-50 odds. The market the market will either go up or go down or stay the same, and you haven't lost out. You lost out on the dividends. But what I'm trying to say is that it's two parts that you have to get right. You have to get the part to get out and get in. And over time, over a 10-year time period, history has proven that investors of all types have not done a good job of getting both of those pieces right.
In fact, I'd even add one thing I'm trying to find if I have I don't see I had a chart on that where time in the market. Yeah, I don't have it off the top of my head. That if you missed 20 years, if you missed the 10 best days of the market, you had bond-like returns. Literally, in 20 years, if you missed the 10 best days. And everyone and their mom says, yeah, but if I miss the 10 worst days, all right? And I said, well, how are you going to do that, man? So if you miss the 10 worst days of the market, you had 1,000,000% return. If you miss the 10 best days, you had it might even be like cash-like returns. It might even be like worse than that. I can't remember. But it's like 10 days that essentially made the market. And as such, because you can't time on both sides, if you just would have stayed in the damn market, you would have averaged 10% a year, which means you're doubling your money every 7.2. So as opposed to saying, I'm going to buy and sell or do this or do that, just stay in the market. Know that you're going to have those ups and downs and just recognize that's the case. We did get a recommendation on a stock to buy, Amar. Harry, our Mandarin speaker, says at these low prices, they're giving away Tesla shares. Oh man, it's like, but wait, there's more, says Harry in Mandarin, because Harry's always saying we'll all be speaking Mandarin soon. And then Pulverizer said, just buy Tesla. It only goes up and up and up. For the SEC people, I'm just reading comments. I'm not making a recommendation on that at all. I still don't know what Nancy says. She's 104. I don't get that. Is that the temperature in Florida or something like that? All right, so get out of the market is high. Yeah, it's all right. All right. So Michael says, people are saying get out of the market is high right now, and the problem is the market is always at all-time highs. And what I mean always, not every day, but I'm just saying. And it wasn't that long ago the Dow breached 10,000. It's all-time highs. Ah, then it breached 20,000. Is that all-time highs? Ah. Then it breaches 22,000. All-time highs. You see where I can keep doing this forever, actually. It's always going up, and it goes down, it goes up. And what I say, and again, I say this with some reservation, is that the market, the gains are permanent, the downs are temporary. Now, we don't know for sure. Nancy says 104.
No, age. Yeah.
Okay. Gotcha. Got it. Okay. I didn't. All right. Right on. Age of Amar's oldest client. Yeah. That's I have a sneaky suspicion he doesn't know why he's still hanging out with old Amar, but
well, I work with the kids now.
Yeah, right on. Exactly.
More than that actual client, yeah.
For someone, go ahead, Mar. Go ahead. Yeah.
One of the questions I saw in here was writing options in an IRA account. You got to be careful because in IRAs you have to be able to fulfill a contract. So custodians will make sure that you have enough cash on hand to fulfill a contract. So you just can't write an option arbitrarily on an IRA. So there's some nuance. Basically, there are nuances to writing options in an IRA. Talk to your custodian to figure those out. Yeah.
Let's see. For someone inexperienced in options trading, how would someone go about search for mutual funds or ETFs that specialize solely in options? I don't know. Any thought on that?
Yeah. So there are some ETFs that only do option strategies, and you just have to read their prospectuses or their mutual fund prospectuses. I know, the name is evading me now, but there is a long short mutual fund out there, and they are long And so they can go both ways, and the way they protect on the downsides through their shorts, and they use the option strategy to short on that side, right? So, and there are also some funds. I think, Josh, we used to have access to this. There are funds that write put call parity option strategy on the S&P 500, and if you compare the S&P 500 to the strategy, it's basically identical. Except you don't have any of the downside swings that the S&P has had, right? So,
so big changes to Obamacare cliff in the latest stimulus bill for us early retirees will drop my healthcare premiums by over 50%. I've heard this. I haven't looked at it. Do you know what? So basically, Amar, I guess that's saying if you're on Obamacare premium credits and you make more than, say, the 400% of the poverty level, you don't just lose all your premium credits. I don't know. Do you know anything about that by chance?
I don't. I haven't read the bill, the whole bill yet. Yeah,
I don't think
we get cliff notes from like our resource partners, but I haven't gotten into them too deeply.
Going back to what Amar was saying, Jill says a lot of people are bragging last March they got out, they went all in cash, but they still haven't got back in. Jill, I still hear from people all the time. They got out. They got out in
08.
At 08, exactly.
Yeah, 08 is the big one. I mean, because that's probably the closest one to recent memory.
Yeah.
Is that individuals? I know people that have gotten out in the middle of 08, like towards the end, so like November of 08, and they still haven't got in. It's like they
always say too, Amar, like, yeah, I got out right for the crash, and I always say, when did you get back in? Squirrel. You know what I'm saying? I was like, exactly. Yeah, that's the point. This is why we wanted to do this presentation. Yeah. There are two groups of people, folks. One, people who are accumulating. Amar and myself, accumulating. There's no reason to get back out. Get out. There's no reason. Unless there's always a reason for you, but there's not a reason for normal people in accumulation mode. Getting out doesn't make any sense. Conversely, if you are right there on the cusp, the precipice of retirement, you got to say, I cannot afford a market cycle like the aughts, or like I'm going to share a screen with you, Amar, real quick, because I cannot stress this enough. I wanted to show you. Mark, can you see the screen I'm showing you?
Yep.
The spreadsheet?
Yep.
All right. This is my man Daniel Coolbert's spreadsheets, folks, at 55e.co, and you can buy it off him. I get no money or anything like that. I just love the spreadsheets. Here's the Nikkei. That's the Japan market. All right. Look at this. We're going to go to the Nikkei. Look at, this is from 1978 and till 1989. 12 years. Sounds familiar. Big runs. 23, 16, 44, 15, 40, 29. Real estate going through the roof. Does that sound familiar? Huge runs of the Nikkei in the 80s. Real estate was way valued, way high. And then kaplink, kerplunk, kaplunk. And then look at that. And they go into 1999, you lost your shorts. Now, we can even go back to beyond 1999 and say, well, okay, Josh, but if I would have stayed in there, we'll go back to, 1 second. Wait, hold on just a second. I love this spreadsheet. Dan, if you're on here, you need to adjust it if you don't mind for adding 2020 on there too. Anyway, so let's go back to, so we weren't just out of the water. Look at this. So here comes 2000. 1, 2. Well, that happened here. I don't know. But if I do say so, there we go. If I do say so, if you retire to that, your butt is, you're doomed. There's no other way around that. And if you were able to take some puts like Amar was, just use a put on the S&P 500, man, you made out like a bandit. You did. And so that's the risk reward scenario that you have to contend with. Where are you in your investing phase? I am still plugging money in. So this 20 and 30% declines bother me not.
Things are on sale. You should buy more when they're on sale, right?
Well, if you have the cash, I always chuckle at that. I buy on the dips. I'm like, with what cash? You're supposed to be invested. You're not supposed to have cash if you're in accumulation. But right on. But still, at the end of the day, you plug. But if you're 60 years old and you're about to retire in a year, you can't have that happen.
Yeah. And so like the downside risk protection becomes more and more important as you're taking withdrawals out of your account, right? And so
well, 100%.
That is probably one of the key things to probably get out of this. So,
real quick, in my book, Retire with Wellington Fund, I talked about the Japanese model, and I talked about how if you even just had Japanese 10-year treasuries, you did fine. I mean, fine, relatively speaking, but your money lasted 18 years. Whereas it did not last 18 years in the or 28 years, I think it was, something like that. It lasted a good amount of time if you just had 10-year treasuries. Now, do not go out there and buy 10-year treasuries right now. I'm not saying that. I'm saying, though, the risk protection of a protection strategy in Japan, in this case, going the extreme of just buying bonds, it paid dividends a big time, whereas having stocks, you got smoked. And as such, there's a happy medium. I'm not saying go all bonds. I'm not saying that in the least. I'm saying we still want stocks, but we can't have a catastrophe, i.e. Japan, which no freaking Monte Carlo scenario up to that point would have ever predicted because it hadn't happened before, but it happened. All right, keep going, Amar. You were saying, you see, all right, here's my man, John. He says, does one have to have a minimum of assets to avail themselves of Amar's services? Is $600,000 a sufficient amount? I'll answer that. You don't have to have a minimum, but you just can't be named John. All right, so sorry, man. But, Amar, you want to address that?
Yeah, no, that's I mean, our firm does have a minimum, but we work with, we're here to help people. So like, if there's a way that we can help, we can figure out a way to work together and to help you. One of the questions that I saw here was Michael said, is a long short mutual fund be considered a hedge fund? So this is interesting because what's happening in the space, in the investing space, you had to used to be an accredited investor to have hedge funds and private equity. Now they're taking those same strategies and they're bundling them in a mutual fund wrapper, right? And the mutual fund, they're putting the mutual fund wrapper around the same product, and they're making them available at the retail level. So some of these long short funds, their minimum to invest is $1,000. So I would say it's a hedge fund disguised as a mutual fund.
It's going to be pricey for sure. Believe it or not, there's some mutual funds out there that are also long and short. PIMCO Total Return Fund comes to mind. Bill Gross, and he's not with PIMCO anymore. I think he's at Janus now. But the PIMCO funds, the reason why they were so freaking always top shelf is because they freaking leveraged like crazy, man. And no one knew that. No one knew it. You actually had to look at what they did in the prospectus, and you're like, oh, I'm buying a leveraged fund. All right, so Jennifer says, Josh, company stopped our pension at the start of the year. 3% was voluntary contribution. I started putting that to VTI. Any thoughts? Jennifer, I don't know what your circumstances are, so I'll just tell you I have VTI. It's my second biggest holding behind VTV. I can't specifically state if VTI is good for Jennifer. I own it though, just FYI. I'm 50 years old. All right, still got a big fat mortgage. Still got 4 kids on the teat, if that makes sense. And I own VTI, my second biggest holding. So I like it, but I will always tell people at the end of the day, VTI, VOO, they were down. The max drawdown was 55% from October 2007 to March 9th of 2009. 55% of your capital was gone in 18 months' time. And if I'm telling you right now, I know that sounds like water under the bridge because we're looking in hindsight, but I will tell this till the day I'm dying. I am the biggest long-term guy in investment that I've ever met, I thought. But I'll never forget. I said, man, in about February of 2009, when Obama got in there, and I thought for sure socialism was coming, I said, I'm throwing good money after bad. For the first time I ever bought any bonds. I didn't buy much. I didn't keep it there very long. But the first time I ever bought bonds, because we did not know where we're going to bottom was going to be out. We did not know. It's easy to think it was out now that you could have saved yourself just staying in the market. I'm telling you, but you don't know that's the bottom of March 9th, 2009. I will say, I was listening to Brian Westbury All right, I'll say this to him blue in the face. Come down De Zavala off of I-10 to get some gas coming out of San Antonio, USA. And Brian Westbury was being interviewed on the Hugh Hewitt show, and Westbury says, "I think we're at the bottom." And he was like, "Why? We got socialism in D.C. Congress was hugely run by the Democrats. Republicans had no veto, no majority, or no filibuster-proof minority, nothing like that." He goes, "They just got rid of mark-to-market accounting." And Barney Frank called a session to discuss mark-to-market accounting. I'll never forget that. And Hugh Hewitt said, "So you think this is what the hell?" And Brian Westbury, he went the whole reason why the market just kept falling and falling and falling. And sure as hell, man, he was right. So the next day I got back in, and I was out of the market for a little, 3 weeks. And I got back in and I said, "All right, well, I like Brian Westbury, so I'm going back in." And that would prove to be very fruitful. But it's easy to say you can handle a 55% decline. It's awful hard when that day comes because you don't know you're at the bottom. And I don't even want to ask Amar that because he can't talk about specific situations. All right, Amar, have you suggested a percentage to be foreign if you are still in accumulation phase? So someone's still accumulating. What do you think about the market?
Yeah. I mean, so this is a big part of currencies, right? So as the U.S. prints more money, we're devaluing the U.S. dollar. It allows foreign countries to, you should have investments in foreign. Yeah. So the answer is yes. You should have a certain percentage of your holdings in foreign companies that are not based in the U.S. just from a diversification standpoint. Number one. Number two is that if you look at all the largest companies across the world, some of them are not based in the U.S. Right? So that you should consider some foreign investments.
Jill says, thoughts on gold and silver to protect downside or diversify. Physical is best. How much it will cost to store? Nothing. I mean, gold and silver is tiny. I've never bought any. I have some thoughts on that. You have any thoughts on that, Amar?
Yeah, I mean, we do own some gold in our portfolios. It hasn't, with the real interest rates rising, gold's going to go down. And so it puts pressure on gold. But the reason why we still hold gold is that, the government keeps printing. and so for us, it's a store of value that I think over time will be a good position to have.
Don't get too caught up, Jill, in the physical cost. I mean, an ounce of gold is literally an ounce. It's this big, or maybe that big. I always hear, "I have to cost a store." What? Huh? We're not talking Fort Knox, man.
Yeah.
So I don't even know what an ounce of gold is trading at, $1,600 right now. So you buy 10 ounces of gold. It's not even a pound. It's not that hard to store. So yeah. I think unequivocally, everyone should have some physical gold and silver. Absolutely. Regardless of what one's takes on inflation, it doesn't matter. It is an oh crap scenario that says, and be careful, my friends, just buying ounces. You can't slice off an ounce to give to your pizza guy. All right. You want to buy the quarters, the quarter ounce, the tenths, but be careful on the tenths because they're very, very light. I put one in one of my Easter baskets for my kids, and we lost it because it's so light. You can't. I mean, literally, it's not even as heavy as a penny, but it's worth a hell of a lot more. So I would highly suggest you buy some silver ounces. Absolutely, silver ounces are bigger than a tenth of a gold. $25 an ounce, so you can store those easily, and then buy quarters of gold and keep it in a fireproof box or something like that. All right, this is a big deal here, Amar. The article I read says healthcare premiums will be capped at 8.5% of your income. Well, that's pretty good, man. If this is true, it's a game changer. So that's on the Obamacare stuff. That's a big deal. That's going to open up some more Roth conversion opportunity. I haven't looked at it, Lee. I don't know that's true. I'm not doubting you, but I don't know the first thing about it. But that's true. That is a game changer. I wonder if it's going to be because that wasn't it was legislation. I wonder if that's going to stick. Or was it just a short-term boom? I don't know. Is that just a one-year thing? I'm not sure.
2 years, yeah.
Okay, so this guy says he was retired, did a video on this about big Cobra ACA changes. Essentially, The next 2 years promises subsidies for the above 400 for the first time. Okay, well, that's good. So this guy says the next 2 years we're going to get subsidies for stupid Obamacare, even if you're above 400% of poverty for the first time. That's good, man. Chicken Charlie says these segments each Wednesday are fantastic. You both do a great job. Mucho gracias. Yeah, we just got we're at 104 right now. So for an afternoon, that's pretty good. Mar, you got 4 people watching on your channel.
Cool.
We do these every Wednesday, 12. We won't do it next week because Amar's going camping.
Yep.
He's going to go camping with the kids. And then we're going to take a hiatus for next week. But every Wednesday at 12:30 Eastern time, 9:30 Pacific, Amar and I will be doing this bright-eyed and bushy-tailed. So appreciate y'all being here. Don't forget to subscribe to Amar's channel at Client First Capital Learning. Client First Capital Learning. 4 months. Yeah, go ahead.
Go ahead.
4 months to retirement. Should I protect my 401k with a fixed fund as I won't take company pension for another 4 years? That's pretty much what we're talking about here today. Absolutely. So,
yeah.
Amar, you said. Yeah, go ahead.
Yeah. So protecting doesn't mean putting 100% into that fixed fund, right? It means figuring out your comfort risk, or your risk tolerance, and how much you feel comfortable with that, and then finding out how much you need to protect, right? Just to be a little bit more. So Bill Gross actually has retired. I see Mark put in a comment there that he's over 75 now. That's true. So he went from PIMCO to Janus and then retired in March 2019. With the pandemic.
Right, so, that's interesting. Let's see. Dan Colbert was saying I was waiting for the Dimensional Matrix book to update the 2020 returns. Okay, gotcha. Right on. So Dan's the guy who did the spreadsheet we just shared. So again, good stuff, Dan. All right. So yeah, Bill Gross had retired. He's over 75 years old now. Sweet. Oh man, right on. So Dan said he did the Japanese inflation rates when I selected the Nikkei on bucket one. All right, so just 55e.co, my friends. It's that spreadsheet I just showed you. It's nuts, and he's got so much on there. And you're not talking to me about it. You talk to Dan, but I think it's $25 or $35 he charges at the best. Prairie says you can stole gold and silver for about 0.5% a year. I don't know why you need to do that, but okay. John's middle name is Luis. Is that cool? Yeah. We'll take it, Luis. All right, thoughts on using income-generating strategies, retirement, butterflies, debit, and credit spreads. And this is my man, I think it's Scott. I don't see a W on here anymore. What do you think about that, Amara?
Yeah, I mean, it's hard to give individual advice on these YouTube things, right. But here's the problem: bonds are not paying a large amount of yield, like from a historical perspective, right? And so most investors are looking elsewhere to get more return, stable return. And the thing with options is that they work well until they don't. Yeah. Right. So you have to be extremely careful with some of these strategies that use options to make sure that in the worst case scenario, you're still okay with it. Right. You're still comfortable with that outcome. So that's what I would say with that.
Going back to stay in the market, Jill said she had less than 10% of what she has now at the high of 2007. But she stood in and she was adding more to it, which allowed her to retire early. I'm telling you, the dichotomy, the accumulation versus the retiree. And Jill says, I'm still accumulating. I'm plugging. Wakes up last year, maybe 2 years ago now. And she goes, okay, now I'm on decumulation. You got to get that mindset. So going back to what my man said, Kurt, 4 months to retire, should I protect my 401k? The days of accumulation are basically over. That doesn't mean we're not trying to get growth, but he's not accumulating by adding assets to it. So going back to Curry's like, I'm not here anymore. I'm literally right here. My accumulation phase is behind me, which means I have got now. It looks like he says he has a pension, so he's got 4 years for the pension kicks in. But it's a whole different mindset, and you got to get your mind right because everyone. I'm telling you right now, I've been doing this for so long, and Mark, I'm sure, can attest this as well. Oh, so you want me to be in that fund, which is underperformed relative to this fund? Yeah, I do. But Wellesley versus Wellington, just for simplicity. But Wellesley hasn't done as well because I don't give a crap the upside anymore. If I'm Kurt here, I care about the downside capture and exposure. And that's what, Matt, I'm just telling you, man, you cannot afford a market decline if you're in retirement. You can't. It's frustrating to me. And I'm not yelling at anyone here, Amar. I'm just, maybe I'm yelling at you, Amar, because I don't like your face. All right. Let's see here. What about, here you go. What about Wellesley and Wellington in retirement? Yeah, right on, man. Pulverizer says, bail on Josh and come on over to Amar's channel. Freaking rats think. Harry says a new cliff for ACA, Obamacare is $65,000 until 2022. Okay, I thought that was a cliff. I don't get it, Harry. That doesn't seem like the new cliff. Hey, we got a different Griff here. So we got Scott W.S. Griffey, then we got Shannon S. Griff 36. All right, Shannon's my name, first timer. Okay, I wonder if that's Scott's better half, old ball and chain. So Kim, I just, Amar can't speak on specific funds, but I will. I love Wellington. I love Wellesley. And going back to my man Kurt up here, if I'm Kurt, I would look at Wellesley as opposed to Wellington right now, just to get my feet on the ground for a couple of years of retirement, without question. Bill Gross, Bill Gates, Schwab are on the autistic spectrum. I'm in good company. All right. Not sure. Okay. Gotcha. Did okay. Not sure where that comment came from, Mark, but okay. All right. So we got any other thoughts, questions, comments from the peanut gallery? Shannon's mail. Gotcha. Well, hey, maybe Scott, you know what I'm saying? Maybe he goes, you know what I'm talking about. Scott is actually on an RV running around this country with his better half. So if Scott is going the other direction, his wife is going to be quickly surprised, if you know what I'm saying. All right, so a 3-bucket strategy will help with economic downturn. I don't know. I find the 3-bucket strategy be a little bit too complex in practicality, frankly. There's a guy up here, Amar, my man, Fritz Gilbert, who runs the retirementmanifesto.com. Well, big fan of Fritz and his better half, Jackie, or how I got one of my dogs. They live in the mountains of Georgia. Anyway, he runs his blog, and he just loves this stuff, man. So he's always looking at the charts and doing this and doing that. I'd rather be out in the garden. I'd rather just jump off a bridge into a pile of steaming finny dog poop than manage this stuff on a regular basis. But some people like it. And so Fritz is like trading back and forth. And so he has a 3-bucket thing. A guy, if I may, Amar won't be able to say this, but if I'm buying a mutual fund that's essentially a hedge fund, look, if you have assets, I would want, I can't make a recommendation on Amar, but I would prefer that you just hire somebody that you can talk to, if that makes sense, because these mutual funds, i.e. hedge funds that are mutual funds or mutual funds as a whole, trying to have a talk with their portfolio manager. It ain't going to happen. It's not going to happen. And so that's a concern if a guy who doesn't know you from Adam is managing your retirement money and you're paying him fees probably more than you'd pay a guy like Amar. I look at it like the more separate you get, the less the other person is he doesn't know who you are. I guess that's what I'm trying to say. All right, so Scott says he's got to leave now. All right, on. All right, Amar, I know you're going to get ready. Do you think it'd be okay to invest down payment money all right, Amar, what do you think about this?
It'd be okay. Yeah, I mean, it's hard because it's like 3 years away. A lot can happen in between where you may find some other place that you want to move into, right? So maybe take a portion of it and invest some money in a balanced fund as you continue to save, and your dollar cost averaging into that fund, and then you have some that's fairly liquid. Just know that you're taking on some risk, right? So.
I wouldn't do it. It's just, I would not do that. You always got to look.
I think it's like 5 years, right? 5 years is like the golden
I think
threshold.
it's 3 years. Let's say at $100,000 down payment. I mean, what are you going to get on that in a balanced portfolio? 5% a year. $15,000. Is it worth it for a potential 40% decline? I mean, even Fidelity Balance Index Fund was down 42% in 2008. So I don't think it's worth it. But I get it. I might be a little bit more conservative. How much longer will the 10-year Treasury keep going up? And Amar, if you got to get out of here, by all means,
Yeah, I got a couple of minutes.
Okay.
I don't know how long it'll keep going up, but I mean,
let's see where we are today. The 10-year. 10-year is at 1.64.
Yeah.
It's still right at where we were February 2020. All right, so February 2020, it was at 1.6, and now it's at 1.6. So if you want to look at that chart right there, that just seems to me is going back to what it should probably have been, frankly, other than the stupid COVID stuff.
Yeah. The yields that are at the top end of our risk range, so it may correct a little bit in the short term, but I mean, yields overall look like that they'll try to increase, even though Powell's trying to keep them down.
All right, so you can always watch this video. It just goes onto YouTube when we're done here, so you can watch it until your heart's content, and I hope that you do, so I get some of that sweet, sweet YouTube money for the ads that get paid. So Sebastian just said, what are the 3 strategies? And you can watch that. For the down payment, use CDs. That's what I would do. Absolutely.
Yeah, some principal protected. And maybe for that individual that was trying to save, using a structured note where you're guaranteed to get your money back, right?
So
you cap your upside, and at least that the difference between 0 and 0.5 that you're getting in a savings account. I don't even know if you can get 0.5 in a savings account.
That's a great idea, Mar. Structured note. The worst case it gives, you get your money back. The best case it gives maybe 10% after 18 months.
Whatever the structured note may be.
Dude, that's real quick. If you got 10%, is that taxed as ordinary income or is it taxed as long-term capital gain?
Yeah, it depends on the type of note, but majority of them are ordinary income.
Okay.
Yeah.
All right, so last one for today. What do you think about investing your emergency fund in a VTI or S&P? No.
No. That was easy.
Nope, don't want to do that. Real quick, retire early says he loves Fritz Gilbert, and Big Earn. Not sure who Big Earn is. I'd rather do spreadsheets than watch TV. Yeah, that's probably why you are on my channel, because I don't watch any TV and I do like spreadsheets. And I like dogs and gardening and sweet nothings with my beautiful, but she does not like holding hands. She's like, don't hold my hand. I'm like, I'm a romantic guy. My wife is just, when she's grown up with 8 brothers and sisters, she got no time for romance. But anyway, all right, Amar, appreciate you being here, brother. Pulverizer, who keeps telling everybody to go to Amar's channel, says we rock. Pablo says he agrees, but we won't see you next week. But if y'all have ideas too, man, for what Amar and I talked about, we'll go back to our regularly scheduled session on whatever the week after March 31st is. But
April 7th.
Right on. Let us know. I mean, maybe I'll do a survey one of these days about what Amar and I should talk about, because there's lots to talk about. It's fun, and it's good. Don't forget to subscribe to Amar's channel, Client First Capital Learning at YouTube, Client First Capital Learning as well. And appreciate you guys being here. Thanks for the questions. See you guys. All right, Amar. See you, man.
Bye. Yeah, thanks.